As property prices increase, so too does the amount you need to save to get the magic 20% deposit. But there are other options. Some might be right for you, but some could be a disaster. Tune in to find out the options and the pros and cons of each one.
Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to move it along and become homeowners. But most importantly, it is for you to become an educated home buyer.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mum. But it's a good thing because between us we've got over 45 years experience to share with you and bucket loads of stories about avoidable mistakes. Together we're going to make sure you get unbiased and real information you can rely on. Allow us to guide you on your home buying journey. We want you to become an educated home buyer so that you can stop looking for your first home and actually become a proud homeowner.
We've got loads of great tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au, and there you'll get access to our free mini course, How to Price a Property Like a Professional. You will also find the holy grail of home buying education, Your First Home Buyer Guide, the online course for people who want to become educated home buyers. We created this for you to help you get on the right path to home ownership for your first home and beyond.
But before we get into the interesting stuff in this week's episode, we've got the boring bit, the disclaimer. You of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording. Things change rapidly, so always check with the relevant government authority and your trusted advisors to get the most up-to-date information.
Today we're talking about options if you don't have a 20% deposit, and let's face it, who does? And our special guest is Cara Haynes from The Loan Market. Welcome to the show, Cara.
Thanks so much for having me.
I'm kind of excited about this one because this is an eye-opener. This is not a recommendation. It's an eye-opener, and I think it's going to be great. I mean, I love all of our episodes, but I'm looking forward to this. Now, in Your First Home Buyer Guide, we recommend people engage a mortgage broker rather than going straight to the bank. Cara, tell us a little bit about yourself and how you help borrowers.
Yeah, so I really love helping first home buyers in particular because it is that, the joy of securing that first property and all the questions that there's no question that's a silly question. And, sometimes you go, oh, wow, that's a really awesome question that I've never been asked. I've been doing this for 12 years and I became a broker because I had a really bad broker. And I was buying a house. I didn't know, and it wasn't my first house, which was interesting that we still, even if it was a subsequent house, we still felt a little bit in the dark about the process. And we found ourselves, begging, borrowing and stealing from family to have all the funds together come settlement day. So, through that process.
Is that because you didn't feel like you knew everything that you were supposed to have leading up to that?
Look, it was one of those things that the market wasn't hot at the time. So 12 years ago, like the market, you put a property up for sale and you say, hello, I'd like this much for my property. And maybe someone would say, okay. Or, then you found, if you held on a week, the property would be getting discounted by another 10,000 or that sort of thing. So I miss those days.
Not much discounting going on now.
Yeah, look, and it was just one of those times that at the time, actually, I was a casual and there was very little licensing around mortgage broking. So there was a few cowboys still in the industry. So I'm still to this day not sure if the broker that we had been recommended through my dad was actually licensed. We'd been recommended a particular bank, and after weeks and weeks, we were told that they don't actually take casual employees. So it was quite a shock to the system because it was like, well, that's a pretty obvious feature that they would have known from the very first conversation. Sure. So yeah, through all of that, I just went, look, I could do a better job. And that's how I became a broker. And the rest has been just a really steep learning curve.
That is so bizarre, as in this is so shit, I can do it better, and that's a whole new career.
Absolutely.
I reckon there's a few buyer's agents out there probably become buyer's agents for the same reason. So
certainly real estate agents do go into the industry because they have a bad experience. I think, geez, I could do that a heck of a lot better.
Exactly. Yeah. And it's a wonderful thing to have that bad experience. It's a gift. It's always a gift.
That's
I love
actually
that.
why I went into recruitment a long time before I got into real estate. But because as a candidate, they never actually called you back and you had no idea. You're just so in the dark. So I thought, I can actually do this better. And I did do it better. And then I took all that into real estate. So it's funny. I hadn't thought about that until just now. Now, we hear a lot of people express the misconception that you can only buy a home if you've got 20% deposit plus purchasing costs. And we see that in the media all the time. It seems to be everyone's talking about New South Wales, Sydney, it takes you 12 years to save up a deposit, and Melbourne is 7 and Brisbane 9 or whatever it is. But the fact is that most people don't sit down and save for 12 or 9 or 7 years for a deposit. So I think what we want to talk about today is, well, if they're not doing that, despite what the media seems to say they are, what are they doing? How are they getting onto the property ladder?
Yeah, I think it's important to understand why we target that magic 20%. So realistically, it's the bank's tolerance for risk. So if the market was if they lend at 80%, it's unlikely that the market's going to drop by 20% and the bank's at risk, right?
Yeah.
So the closer that we get the lending up to the value of the property, so the higher the loan compared to the value of the property, the higher the bank's risk. Now, once upon a time, like pre-GFC, we saw people being able to lend 100% plus costs. And it took years for people to realise actual equity. So they kind of cut that out. And even when I started broking, there were things like, you could get a 30 grand credit card to cover your stamp duty and all sorts of crazy things. So the banks are still governed by APRA. APRA have definitely, put some of our,
Heighten the restrictions.
Yeah.
Exactly. They're going, hey, if you want to be a bank, these are some, guidelines that you should really be adhering to.
Cara, I remember taking out a loan when I started my business, and all I had to do, it was called a no doc loan, and all I had to do was sign to say I can afford the repayment.
Yeah. Well,
That was
there's
it.
a term that floats around the industry called a ninja. So no income, no job or assets. Ninja loans used to be a thing.
Yes.
Well before my time.
Right.
But
Yep. Yeah, I'm talking 18 years ago. Yep.
yeah, exactly. And sometimes way back when it was,
Risky.
you
Yeah.
got lent, a bank would approve you based on character. Like, oh, I know Joe.
That's true.
He's a good guy.
Our parents used to, get dressed up really nicely and go and meet the bank manager and shake hands and, be on their best behaviour.
Absolutely. And so we've kind of moved from that, once even 15, 20 years ago, it would be, oh, you want to buy your first home? We'll go see Susie down at the bank branch and she'll hook you up. People are definitely moving away from that now. And because realistically, if you've got a relationship with a bank, it's unlikely that's going to do you any favours in the current lending environment, right?
true.
They'll still have bank policy. And I hear it all the time. People go, oh, I've been banking with them for 20 years and they've said no to me for a home loan.
Yeah.
It's like, well, yeah, because they've got these APRA guidelines and credit risk, their own internal credit managers saying, this is how we want to manage our portfolio. They've got so much money to lend and they can pick and choose who they lend it to.
Yeah.
So we often find, some banks will start to be really competitive in interest rates for loans over 80%, so people with less than a 20% deposit, because they just want to balance their book out. 20% is pretty much the golden number for banks. If they say, well, if we're going to take a riskier loan or approve a riskier loan, we want to take some insurance to make sure that we're covered. So that's where lender's mortgage insurance comes in. It protects the bank. It doesn't protect the borrower. But I'm not actually adverse to paying it, because in a hot market, for example, it's way more affordable than waiting to get a 20% deposit. If you're waiting 9 years or 12 years, you're looking at a completely different property and you're just chasing that 20%.
And your borrowing capacity can change if the bank's interest rates. Now, I just want to set some assumptions here, because we're going to do some sort of little calculations and guidelines for people, because what we're talking about is, if you haven't got that 20% deposit, what are some of the options? So the assumptions we're going to use today are, we're using a $1 million purchase price. I know that's not all first home buyers, but it's certainly in Sydney, now a bit more so in Brisbane, and it's easier for us to calculate. So
that's the bottom
why
line
we're
here.
using that number. Okay, so the properties we're using today is, if you are looking at a $1 million purchase, and that would mean if you needed to save your 20% deposit, you would need $200,000 plus costs.
So in Queensland, that would be about 240 if you were going to pay for stamp duty, solicitor, all those sorts of bits and bobs that come into the mix.
Yep. So we're going to, for today, for the assumption, we're going to say that costs are 5%, so $50,000. So cool. $250,000 is what you would need to buy our hypothetical $1 million first home today.
Great.
So
great.
Before we go into these various scenarios, like I would imagine that if somebody has a capacity to save up $250,000 in a relatively short period of time, they might actually have quite a high income, in which case their borrowing capacity would be a lot greater than 80% plus your 200, right? So I think from a mortgage broker's point of view, I would imagine people come to you having saved a certain amount of money, having a certain amount of assumptions around what they can borrow and all the rest of it. Where do you go with that? Where do you start in your conversations? Do you go straight to income, or do you go straight to what they want to buy, or what is it where do you start with them?
Yeah. Well, there's certainly two aspects to every loan. So the first one is equity or deposit. So if you don't have the access to equity or a deposit, and we'll go through obviously the different forms of what that looks like. So first is like, I can't invent $250,000 for you. So if we don't have access to that, it's like, okay, well, what do we have? And then we can work with that. It's like, is it a 5% deposit? Do we have a mum and dad who can help out with equity as a family guarantee? Do we have the ability to take some kind of shared equity scheme, or, you know, a personal loan, various different things. So that's step number one, because the bank's risk still needs to be managed.
Yep.
And then from there, we then flow on to income. Now, if you've got a huge income and no savings, the bank's going to ask questions like, well, where's the money? You know? And I'm going to ask questions like, can you afford the loan? So it's a fine line that we kind of balance that out. And so quite often I can find this like magic number of like, this is what your deposit is. People on high incomes, generally, if we get them pre-approved, we might get them pre-approved for significantly more than what they can borrow right now, because every month their deposit's building. So they might actually just purely be limited by deposit. Other people may have a massive deposit, but they're limited by their incomes, or disposable income to service a loan.
Yep. Great.
So, and I think that it is a great outline. It's really valuable, because I do know, like, we've had the situation with clients of ours where they've got really good incomes, but they just haven't actually knuckled down to save because they've just been enjoying their money. And then they're like, oh, we can actually afford a house.
Yeah.
So now we need to show some savings records. So, I mean, and this isn't most people. Most people are doing it the hard way. We get this. There's only a small percentage that have the luxury of high incomes and you know, they haven't had to have the discipline. So let's just cover them off very quickly, and then we're going to work on what people do if they're really struggling to get that deposit. But so if there's a high income person that doesn't have the deposit but does have the wherewithal to pay a loan, how long do they need to sort of show some real savings or ability to save before the bank will actually look at them seriously? And even if they do borrow a huge percentage and pay the LMI, I mean, how much, I guess, how long do they have to show that they're capable of it for?
Do we want to use the example here? So we've got some high income earners who have got the side of the equation, which was serviceability. So they can show that they can service a loan. They haven't saved enough to show that, well, you know, they've been having Wagyu and Shiraz. Remember that case where, you know, someone said, yeah, I've been living it up because I haven't got a loan, but when I get a loan, of course I'm going to cut my lifestyle back. You know, I'm going to do it but I haven't had to. So let's go with that example. What are the options available to those people that might have, you know, maybe they've got $45,000 saved?
Yeah. Okay. So realistically, first of all, we need to have enough money to cover your stamp duty and things like that, because that's not something we particularly like to loan for. And as well, not obviously, you ladies are buyer's agents. We need to have some money that cash available to put down as a deposit on the contract. Just the cash flow of logistics of paying the solicitor to do searches and all sorts of things like that.
Yeah, exactly.
So we've got things like if you've got wonderful parents, they are great, and I'm seeing a lot more parents becoming guarantors for kids when they're going over that sort of 750, or depending on the state, obviously. In Queensland, it's 7, or in Brisbane Metro. If we can't use the government scheme, then we sort of cascade over to parents and go, hey, we need to spend more than 750, or maybe the kids earn more than 200 grand between them. Okay, now maybe it's
so they
mum
don't
and
qualify
dad's.
then for, that there's a particular scheme that you can access, which, do you want to just outline that so that we...
Yes. So there's a first time guarantee.
That's it.
There's also one that's called the family home guarantee, which is a 2% deposit. But in all these instances, you've got heaps of criteria that you've got to meet. Now, generally speaking, the 2% one is just a really intricate one that I recommend you just get specific advice on. It's got so many loopholes, like, oh, you're divorced, but can you show a
Generally
certificate
a
of
single
divorce?
parent sort of situation, isn't it? Or a single
Then you've got to
caregiver.
prove that you're divorced. Not just say, oh, I'm separated, or you've got to have the divorce certificate. So that's where a lot of people get caught out.
What if you never got married in the first place?
Well, that's next level. So yeah, you've got to prove that you're not together.
A lot of hoops to jump through for that one. Look, the intention is good to help people get into the market where they haven't got the deposit saved at that point in time, but have got the capacity to make the payments. And I guess that's what we're trying to say here is that's an option for people. There's lots and lots of criteria around it.
So many options, but so much criteria. And people often assume that any first home buyer incentives all have the same criteria. But you've got federal ones, you've got state ones, that sort of thing. So one would assume that the governments would talk to each other, but they sure as heck don't. So yeah, we've got to kind of go, okay, well, you might be eligible for this one, but not this one because of X, Y, and Z. So generally speaking, if you're earning under $200,000 as a couple, that ticks that income criteria on that first home guarantee. But you've also got to be within the thresholds of the capital city or the regional area that you're choosing.
Yeah.
And it's a great website that you can just punch in some postcode, different postcodes, and see if it's classified as metro or regional. When the scheme first came out, Gold Coast was considered regional. So they had really low caps, and then everyone was up in arms, like, I can't get anything on Gold Coast.
Can't afford to buy something there for that.
It's now classified the same as Brisbane. We look at those schemes first. If that's not something that suits the customer, then we cascade over to like, okay, well, do we have parents who might be able to help? I usually then go with a conversation with the parents, and totally separate to the kids, or going, hey, what's your financial position? What do you want to do? How can you help? And sometimes it leads to the parents don't want to be guarantors because they've worked really hard to get the bank off their house, but they might say, hey, I've got some cash I can pull out of super. Can I give them a gift that would help them out? So, and it might be a matter of, okay, we don't avoid mortgage insurance with a gift, but it's going to mitigate if I can give them a different magic number of going, well, look, if we can get to a 10% deposit, that is going to halve their mortgage insurance rather than if they did it without your help. So that every customer is different, and we need to tailor those solutions for each customer.
So that bank of mum and dad sort of solution, where they're somehow either tipping in equity, which is what they own in their house.
The bank takes
the bank
a mortgage on their house.
It then becomes a mortgage property. So there's risks for the kids as the borrowers, and there's risks for the parents as the guarantors.
Absolutely. And there is that psychological thing for parents as well. Like, quite often they have worked really hard to pay off their loan. And it's a massive day for someone to go, I'm getting the bank off my house.
Yes. So it is, isn't it? You used to get the title deeds. The bank used to physically hand you the title deeds.
Yeah.
It was quite a day.
It's less exciting
electronic
now. It's like, oh, we've pressed a button. But, that was a big deal. And I still have those conversations with older clients. And I'm going, Cara, we're about to get the bank to remove their name off the title. It's awesome. So you've got to remember too, parents love their kids and they want to help in any way they possibly can. But there's also that, like, oh, wow. Like, so my first question is, are you aware that by agreeing to be a guarantor, the bank will be listed on your house again? And it's a mixed reviews.
It's a moment, isn't it? It's like, oh, what?
Great. Some people are like, that's fine, no problem. Others are like, whoa, we might have to, think about whether that's what we want to do.
Yeah.
We love our kids, but
and not everybody just has one child. So how do you go, all right, well,
Exactly.
and I know as a sibling myself, I would be going, well, if he gets it, why can't I get it?
Absolutely. So it's balancing all those stakeholders of going, well, if we go guarantor, can we go guarantor again for the next child coming through the ranks? Or, saying, hey, we have this pot of cash, we want to maybe divvy up so that we've got enough to give to, the equal amount to all 3 kids, or, minefield.
Absolutely. So lots of discussions to have.
Yeah,
Absolutely.
and that's and we've done a few episodes on this as well in terms of the discussions to have and considerations around an agreement that you would have in place. But not everyone has access to the bank of mum and dad, right? So I know that there's a number of shared equity schemes that are being created, various governments. I know Victoria's got one, and there's a federal scheme. That's sort of like, that's for people that need to be adopted it's like being a ward of the state, isn't it? Like your parents can't look after you, so you're going to become a ward of the state. So how do they work? And I know they work differently, but how do they work? And so I guess, do you recommend people consider that? And what type of person would you recommend consider one of those shared equity schemes?
Look, at the moment, the shared equity schemes through the government are really, to the best of my knowledge, only available in Victoria and New South Wales at the moment, so state government based. The federal one is still in the wind. So there's nothing, say, in Queensland for Queensland buyers or that sort of thing. Now, the government will own part of your home, and I think that's a really tough pill to swallow as well. I mean, same as mum and dad, it's like, well, do you want the government owning part of your home? And there's a whole bunch of different caveats on that. You're also obliged, I think in the southern states, there's only about 3 banks that will offer those schemes.
So you're limited to who you can borrow the money from.
Absolutely. And brokers can't, I know, we talk about brokers acting, in clients' best interest. We can't actually act for you for those equity schemes. You have to go direct to the bank.
Direct to the bank. Yeah.
I did not know that. So there you go. That's why we're talking to you, isn't it? So we can understand this.
So there's definitely
an option. It's an option worth looking into, but lots of pros and cons, and maybe more cons.
Yeah.
How do you buy them out?
Shared equity
Let's
in
actually
the
talk
past.
about that. How do you buy shared equity out? So let's say you do go down that path. You've got a position in Victoria.
It's funny because it's so new that I haven't had a lot of experience in getting it out. But I would assume as long as you could get a valuation at a different bank or the same bank, if it showed that you've got enough equity of your own to, essentially refinance the mortgage, then it should be semi-straightforward. It's the same with the first home loan deposit scheme. We generally asked to be removed when, the time comes that you've built enough equity that you can stand on your own 2 feet.
Yeah. Okay.
They're so new, and they're,
a bit untested,
sometimes you don't really exit
they?
They were years ago, and I believe they were fraught with problems, but, time heals all wounds when it comes to government initiatives. So,
but what you've got me thinking here is that if they can't use a broker, because we recommend that people use a broker, and a broker like yourself who is willing to sit down and go through all the different options and explain things to you in a way that you can understand, and so then can put forward a recommendation as to a few different paths perhaps that you might go down, and which bank you would go and for why, and perhaps thinking about refinancing at a time where you can build a certain amount of equity and get into a different lend. So it's about borrowing strategy, isn't it? It's not about just basically getting in the market at any cost and chasing the cheapest rate. It's much more strategic. But the problem, of course, if you're going from those shared equity schemes, and I hadn't actually realised this, is if you rely on going to one of those, say, 3 lenders, you've got to go and do the legwork and compare each lender. You've got to work out which one is likely to actually be the best one for you yourself without any actual independent guidance. And then at the point of time...
it's really hard to find information publicly about the execution.
Yes.
Even researching for this episode, I found it as a mortgage professional, found it really hard to find the actual, the minutiae of how, what's needed and how do you get out of it and what's the catch.
Yeah, and I would imagine that part of the reason for that is they haven't got to the point where anyone who's taken advantage of this scheme has actually got to the point where they're able to buy the government out. So therefore, it's almost premature. But the thing too also is that at that point at which you might have enough equity, or you might be able to get refinance, or however at work, or your income has risen to a certain amount, because I know there's income caps with some of them. And if you actually start to earn more than that income cap, you are forced to do something about that. And so if you don't actually have good independent advice around that, or know where to turn to get that advice, then that's actually a little bit risky for first home buyers, I would think. So, and that's a bit of a problem, because, you know, we do look at a borrowing strategy, and that's why we do like to work with brokers, but you haven't actually got that relationship with the broker to be able to go to them and ask for that advice at that point of time. So that's an interesting one, and that's something that I think we should probably think about more.
Yeah, and it's a shame that that's been taken out, because it is so risky, and brokers are very good strategic brokers are very good at looking at things from all sorts of different directions. And if you can't bring that into the mix as a potential, because it's outside of your remit, the service that you can provide, then
we can't advise on it because we don't have that accreditation. Yeah, so sometimes we'll say these are the options through standard channels, but hey, you know, go see
somebody else about this one. That's insane.
Well, just go and talk to them about this particular, and so that at least then we can weigh up, okay, well, is it better? It's the same as, you know, a defence, people in the military who have access to defence loans. It's sort of like, well, do you get a stipend and a discounted, defence loan, or do you take a standard loan without the stipend? You know, and sometimes it weighs up better, to not do the defence stuff.
Yeah, again, you need that independent advice,
that holistic
advice.
Can
I give you a metaphor for this? It just reminds me, when my daughter was about 3, we went to Europe for a holiday, and I needed to get from Manchester to Sardinia, right, flying. And the travel agent said, well, you could go direct with Ryanair, or I can arrange it, but you have to get 3 planes. And the travel agent said to me, it's risky, these low cost airlines, they're not really safe, and all that sort of palaver. And so I went along with that. But the stupid thing was that we ended up getting three planes, and probably cost 10 times the price too, now I think about it. But it also took 12 hours as opposed to probably would have taken 2 hours. So this is a situation where, because travel agents couldn't actually the low-cost carriers wouldn't deal with travel agents. So it was a situation where I actually got really bad advice from the travel agent because they were locked out of something. So this is a slightly weird metaphor here, because of what I'm saying is that you need to go to a mortgage broker because you need to get great advice. But the problem is that you could go to a mortgage broker who will talk you out of using that equity scheme if it actually is the right thing for you. So it does, the way it's set up is really poor, because if you want to have true independent advice, you need to be able to get good advice around all of
access
these
to everything.
schemes, not say, well, you can't fly the cheap airline,
absolutely,
which might actually save you time.
And it's the same as an online lender. People go, oh, hey, these here, and it's like, well, yeah, like they won't deal with brokers. So like we can broadly give some rough advice, but we don't know what the hidden fees are. We don't know what the service level are.
And you haven't got much access to conversations with those online lenders to actually ask in-depth questions. You've got to be able to read the
Well, some of them
contracts.
blanket won't deal with brokers.
Yeah, got to read those
we're
contracts.
online. You talk to us through a chat function.
Yeah, and look, honestly, this is way more important than getting a flight from Manchester to Sardinia. I think you need advice, is where I'm coming from. I think that a good broker, though, will actually suggest something to you that is outside of their remit, knowing that you potentially going to become a long-term client. And I think that we really encourage people to work with brokers who are prepared to actually take the time to give you good advice and have that long lens, and are looking at you as, developing a relationship with you for the long term. But it is tricky, because it's putting brokers in a tough situation, because, of course, it might be a good solution for someone, but you also don't need to learn about the nuts and bolts of it either, because it's not in your wheelhouse, really.
Yeah. Now, I'm going to get us back on track, because
I like to take us on a rocky
what we
path.
want to talk about today are what the options are if you haven't saved your 20% deposit and your borrowing, or your costs, your purchasing costs. Yeah. So we've talked about the shared equity schemes briefly. We've talked about what's in and out of a broker's wheelhouse. We've talked about some of the other government schemes. What we've touched on, but we haven't really gone into is LMI because it is an option. So lender's mortgage insurance, as Cara very well described earlier, is when a bank has said, well, we'll lend up to 80% of the value of a property, but you either have to come up with the other 20% yourself, or it's too big a risk for us. We want insurance in case you can't pay your loan and we've got to sell your house. That's what the insurance is about. And that's called lender's mortgage insurance. Cara, this is an option for people that sometimes they're, I think, unfairly told not to use. But I've used it. I used it with one of my purchases because I couldn't outsave the market.
Well, this is the thing, right? It gets you in a home sooner. And particularly in Brisbane, where we've seen the market moving at a phenomenal rate, how units have gone up was something like 6% in the last quarter.
Yeah, look, they've been about 17% year on year, and 12 months. And I think houses have been something like 17 or 18%. How do you save that?
So it's just crazy. So you're trying to save for a 20% deposit, and the goalpost just keeps moving. So mortgage insurance, I think it's a great, the fact that it is an option, I think is fantastic. I'm not against paying it. I'm against paying it blindly without doing research because a lot of people will think, it's the same at every bank. Like, oh, I've got a 10% deposit, so mortgage insurance is this much. It's actually every single bank has a different negotiated insurance premium.
How interesting. Good tip.
So sometimes it's a matter of going, hey, we've got to pay mortgage insurance, but let's pick the bank. It's not about interest rate. It's actually about right now, it might be, hey, let's pick the bank with the lowest mortgage insurance because it's a one-off premium. I think that's important to note as well. It's a one-off premium. It's not like paying your house insurance or your car insurance that it's every year. But it is an establishment cost ultimately.
And normally it's built into the loan amount though too, right?
Yeah. Typically we add it to the loan. Some people will ask me, hey, what if I pay it up front? It actually works out when we crunch the numbers, it works out cheaper to add it to the loan because if you had the money to pay it up front, you're ultimately reducing your base loan. Yeah. So if say mortgage insurance is $30,000, you're better, and you've got $30,000 to pay it, you're better off having a bigger deposit by $30,000 and then adding the LMI on because your LMI premium will actually be, potentially several thousands of dollars cheaper than if you borrow $30,000 more on the base loan.
So my brain just automatically went, but you'd be paying insurance if you capitalised it, as in put it in the loan amount. It's not insurance, interest.
You'll obviously pay interest over life on that piece, but quite often, it's a pretty significant difference, and particularly if we're talking about $1 million loan. So just to give you an example, if we went into $1 million with a 10% plus costs deposit, so maybe you've got about $150,000, you're looking at about $20,000 as a bare minimum for mortgage insurance. We can juggle the numbers, but in that instance, if you borrowed 90.01%, your mortgage insurance is going to be astronomically more expensive.
There's a sweet spot, isn't there?
Spot.
It's the broker's dirty secret. There is a sweet spot where
it's about 2.5%. And I'm a big numbers geek, so I've played around with all the little variables. And some banks, the variables slightly different.
Is it about 88%?
Well, 88's beautiful. I love 88 because you get better interest rates too. Because you're typically mortgage insurance is going to be about 2% if you borrow 88% of the property value. Your mortgage insurance is usually going to be 2% on top, so you're staying below 90%, and that's where the banks will still give you some good rates and all sorts of things. In converse, if you went to 90% and added the mortgage insurance on top, your rate's going to be higher because you fall into that less than 10% equity category.
That's why that 12% is magic.
Yeah. So every 2.5%, 2 to 2.5% tends to have a pretty big drop in what the premium is, but then we'll look at across all the banks and go, okay, well, just as an example, there's one or two banks right now who are doing mortgage insurance cashbacks. So if you're taking a loan with them and paying mortgage insurance, they're going to give you $2,000 at the back end. So all of a sudden you're saving $2,000 on mortgage insurance.
Oh dear. And we are in the industry, and these are the sorts of things that, because this is not our area of specialisation, we can't be across this sort of stuff.
Yeah.
I mean, how is the average person going to be across this sort of thing? And that's why, again, a mortgage broker knows these kinds of little things that change. They change weekly, daily.
Absolutely. I mean, we get thousands of emails from different banks. We've got over 60 banks on our panel. So every time there's a tiny change in policy or credit, we get an email. And then sometimes we just sit in the back end and be the numbers geek of going, okay, this is exactly how much. It's usually easier if we know exactly what we're buying and exactly how much cash we have available. So then we can.
Which not everybody knows what they're buying, do they?
No.
Because the pre-approval comes first.
Yeah, pre-approval, we'll usually say, look, if you were buying a house today, this is probably going to be the best bank for you. It's not to say that we can't divert banks when you sign a contract, but generally we like to make some assumption. We have to assume some things so to make a choice. Otherwise, we'll just go around in circles and go, we don't know which bank we'll ever use.
Yeah.
Actually, on that, can I just ask a couple of questions about pre-approvals? Yeah. Because I'm finding that there's sort of there's a school of thought out there, if you like, that you don't really need a pre-approval. As long as you know the bank will lend you money, then you don't actually need to have that piece of paper that says the bank will conditionally, because it's not a completely unconditional offer, they'll conditionally lend you the money. Now, so do you agree with that, disagree? How would you respond to that?
Well, if I have a customer who has fantastic income and I've run credit checks and I've looked at all their accounts and they've got 20% deposit, that's one thing. And it's usually in the customer's court there to say, hey, if you're using a buyer's agent, we usually will 100% recommend a pre-approval anyway. If you're going to auction, I will tell the client it's you not sleeping well at night, not me, if you choose not to do a pre-approval. I want that pre-approval. Anything that's remotely going to be unconditional or super short finance clauses. Sometimes a customer who potentially has loaned for and knows they're a good borrower, sometimes they'll say, look, our biggest priority is the cheapest rate and we're happy to proceed without a pre-approval. Personally, I like them for peace of mind, particularly for first home buyers. Yeah. No one's holding a gun to your head to borrow the amount you pre-approve for. A lot of people think, oh, well, if we borrow more than what we think we're going to need, we have to take it all. It's like, absolutely not. Like, how wonderful to not have to spend everything that you pre-approve for.
Yeah.
But also, you don't need to use that bank at the end of the day, but it's the best guess bank that if you bought a house today or tomorrow, the process is going to be seamless.
Right. And so the next question on pre-approvals is, if you are in a competitive market or you're going to auction and you need to offer an unconditional offer, or, you don't, well, particularly auction, right? Let's just talk about auction for a moment, because obviously there's places where you can buy with a finance clause potentially, but when the market's really, really hot in some places, you don't have the luxury of that. You've got to take a risk, right? And you might have pre-approval, but the problem is, and with most first home buyers, are going to be very reliant on that valuation, aren't they?
Sure.
So there's I'd like to understand the type of advice that you would give a first home buyer who's about to go forward, making an offer or bidding at an auction, where there's that risk that they've got the pre-approval, but it still hinges on evaluation after they've committed to the property.
Yeah. How
do you advise a client to mitigate that risk?
Yeah, particularly if there's a hot market that you're essentially seeing suburb records being set every month, that's really risky. If the valuer, I've never seen an auction valuation come short, but, I've just put that out to the universe. Generally speaking, there are certain customers that I would recommend you do not make any unconditional or auction terms on when buying. And that's purely because it might be there's only one or two banks that would consider lending. It could be they're under the scheme, those sorts of things. If there's the government scheme places that are limited towards the end of the financial year, sometimes we go, hey, this is the only bank that's left with scheme spots. So if that property then is undervalued, it's a dead duck. So generally speaking, if you don't have a 20% deposit, we'll usually sit down with a customer before auction and say, well, look, these are the risks. This is the potential mitigants if it came in low, and really put it in their court as to where their propensity for risk lies. Some people say, well, if there's an element of that, I'm just not bidding. And we talk them through, well, okay, why don't we make an offer prior to auction, and if it gets passed in, if they don't accept it, okay. Well, then it gets passed in, then we can look at, a short finance clause, or at least subject to, it could even be just 3 days finance, but just enough to give them a valuation.
We always say to people, a pre-approval is about you as a borrower. That's what the bank is approving, is you as a borrower. But then they also have to approve the property as the security for the loan that they're making. So it doesn't matter what your income is, what your deposit could help, because if you've got 70% LVR, then you might have a little bit of wiggle room there that you could put a little bit more cash in, have a higher LVR if you need to, if the valuation doesn't come in. But that's where the risk sits, isn't it? Because they could be approved. There might be some conditions on that, but it's the property itself that is the valuation side of the equation.
It comes back to those two elements of, your income. You've got to have the income to support the loan, which is that pre-approval,
yes,
and the good credit history and whatever. But then you've also got that bank managing the bank's risk on the equity and deposit. So if
when you're in a competitive market, I know this in Sydney because obviously we're very much an auction market in my neck of the woods anyway. That if you said to all first home buyers who've got less than 20%, well, don't bid at auction, well, they won't be buying a property.
Yeah.
And so therefore they need to have some really good guidance around, and I'm going to recommend that they do our free mini course on how to price a property here, because that actually is a process very similar to what a valuer would do actually. And so they're going to be looking at the same information that valuers are going to be looking at. And so that can be quite telling. But and there are certain types of people that are less risky as borrowers than others, the high income, for example. And when they've got lots of different banks that are quite happy to lend to them, I guess you've got a contingency plan, don't you? If this one falls over, we can go to another one and another one.
Yeah.
But I think I take your point as to what you're saying, that if you are a high risk borrower that really only has a very limited pool of lenders that are going to lend to you, if you've only got one, for example, or if you're getting one of those few remaining spots, then that is a scenario which it's extraordinarily more risky for you than it is for the average buyer. And I think that this is where it's really important to have these conversations with your broker, because you do not want to be taking unnecessary risks with your
deposit. At least knowing what the risks are, then you can make that judgment call.
Yeah, absolutely.
Look, we've covered a lot of ground today, and what I've really taken away, and Veronica and I love interviewing people because we learn more and more. The more that we talk to other people about their area of expertise, the more we learn, which is fabulous. But what I've sort of taken away is when you haven't got your 20% deposit and borrowing costs, there are options. You do have, and it's a bit important to have the conversation around, don't shut off any option. Have conversations with an expert, with a mortgage broker. What are my options? If I can't outsave the market, I really want to get in now, this is how much I've got. What are my options?
Absolutely.
Don't shut off an option thinking, well, somebody told me I should never do that. Really talk to an expert who knows the ins and outs, because there's pros and cons of each of the options. They're not going to suit everybody. Some are going to have more risks than others, but some might be more of a risk that's palatable to you at this point in time. And you're not locked into these things forever is the other the other thing I sort of take away.
And if I may just add one more thing about mortgage insurance, there's a lot of banks now who are waiving mortgage insurance at certain levels for certain professionals. So even nurses, teachers, emergency services workers, we all know about medico and legal and accounting type waivers, but the list keeps getting longer, and those lists can change all the time. And so it's wonderful to go. Last week I spoke with a client and said, look, normally you'd pay $30,000 in mortgage insurance here, but because you're a teacher and a nurse, we can choose a bank that's going to waive that. Like, how cool is that?
That's great. Yeah, that's really cool.
So all of those misconceptions that people might have, they need to throw them out the window, because you don't know what you don't know. But a really good broker is going to open your eyes to what the options might be, and that's exciting.
Absolutely. Yeah.
Quick, go and make an appointment.
And thank you, ladies, for educating, the wider audience. I think financial literacy in Australia is quite lacking, and I just absolutely love your podcast, and I'm really excited about your academy course, because, there's, like I said, there's you don't know what you don't know. And I found personally your podcast series are just phenomenal with all this information that's just so valuable.
Well, thank you so much. Now, tell us, Cara, what is the one, this is a question we ask every guest, by the way. What is the one thing that you know now that you wish you knew when you were a first home buyer?
There's so many learnings. I think with every property you learn, every purchase you learn a little something different. I think understanding that property is a long-term investment, that's where you're going to get the best, return. So where I see, I'll use one of my first properties as an example. I bought a fabulous, 3-level townhouse in a good suburb in Brisbane, and it was a party house. It was awesome. But at the time, I could have used the same money to buy probably a little bit further out, and not that much further out, but, an older house on land. And that's probably one of my biggest investment regrets of going, well, that party house was fantastic for about 2 years before interest rates started to skyrocket. I couldn't afford to live there anymore, and I had to move back with mum and dad. And then I met my now husband and wanted to start a family. Like, just knowing that a property that suits you now is not necessarily going to be the property that suits you long term. And going, well, it's very expensive to buy and sell houses if you make the wrong purchase. If it just suits you right now, it's very expensive, and it eats into your net wealth. So if you can think about when you're acquiring a property and going, well, it suits me now, but will it also suit me not just for the next couple of years, but could it suit me 5-10 years down the track, even as an investment holding? I think that's a savvy decision.
That's a brilliant first learning. I mean, my first property was very different, and anyone who's listened to the episodes where I've told my story, but the mistake was very similar. You know what I mean? I just didn't have that longer lens. If I look one suburb further away, I could have bought a much greater asset that I would have actually been able to hold and live in for a lot longer. Yeah. So totally get that. That's a great one. Thank you, Cara.
My pleasure. Now, thanks for having me.
We have absolutely enjoyed that. As I say, I've learnt a lot, Cara. We may have other topics for you down the track. I'm sure the listeners have also learnt a lot as well. Now, have you joined our Facebook group yet? It's called Your First Home Buyer Guide Australia, and it's your opportunity to connect with us and ask us questions. You'll get answers from us, which means you'll be sure you're not going to get led down the garden path.
And a quick note on these podcasts, you might think that we cover everything you need to know, but a word of warning, we don't. In each episode, we can't, right? We're just scratching the surface here. Now, if you really want to be an educated first home buyer, you need to learn all of the steps and how to do everything in the right order.
Our First Home Buyer Guide course only costs $990, and you get direct access to us to help guide you through your negotiations. You can also share the link of any property you're thinking of buying, and we can help you work through whether it's A, B or C grade or an absolute no-go zone. Trust me, you'll buy better with our guidance, and you'll overpay by a lot more than $1,000 if you don't know what you're doing. In this episode, we've only touched on a tiny part of the huge amount of things you need to know to become an educated first home buyer. There is so much more for you to do. You can learn all of the steps in the right order and avoid all of the mistakes that others have made in our 10-step online course for first home buyers.
If you'd like to learn more about the right process and avoid making rookie errors, become an educated home buyer. Head over to the website, check out Your First Home Buyer Guide, the course that we have created for you. And don't forget to subscribe to the podcast so you won't miss an episode. And if you've liked what you've heard today, please give us an iTunes review. It helps other people find us. And of course, I know it's a bit cringy, but we're going to ask for 5 stars. Thank you.
Thanks for joining us. We hope you've found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with more priceless stuff.